Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing GlobalFoundries stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. GlobalFoundries is a foundry semiconductor company. Foundry means it manufactures chips for other companies. Taiwan Semiconductor is the largest foundry in the world. Fabless means the company outsources manufacturing of its silicon wafers or chips to companies like GlobalFoundries. Fab is short for fabrication, which is just another word for manufacturing. Nvidia, Broadcom, and Qualcomm are some of the world's largest fabless companies. This company was created as a spin-off from Advanced Micro Devices. It manufactures chips designed for smartphones, cars, computers, Internet of Things, and the industrial market. The company works with the governments of the US, Germany, and Singapore. This is one of the few semiconductor companies that does not manufacture in Taiwan or China. Some investors view this as a big positive because the company has so much less geopolitical risk. Before GlobalFoundries IPO'd, it appeared that Intel would acquire them for $30 billion, but obviously that did not happen. GlobalFoundries was concerned that the merger would upset some of its key customers that compete with Intel, such as Advanced Micro Devices. Also, the merger would face intense antitrust scrutiny. The company is headquartered in Malta, New York, and was founded in 2009. The ticker trades on the Nasdaq, Deutsche Börse, and Börse Stuttgart. Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $49 a share, and they have 532 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is improving. It was negative $1 billion in 2018. Then it dropped to negative $276 million. Then it was positive in 2020, but they did have a small negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also improved from negative $2.8 billion to negative $1.1 billion. Revenue is the sales for the company, and that's declining from 6.2 billion to 5.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to manufacture the semiconductor chips is part of cost of revenue. That includes cost of labor and cost of materials. Revenue minus cost of revenue gives you your gross profit. And that is negative every year, but the negative is pretty small in the trailing 12 months. Below that is operating expenses. Depreciation is a big operating expense for this company. And below that is their operating income, which is negative every year. But the negative is improving. Below that is the interest they pay in their debt, which is $108 million, which is lower than 2018, 19, or 20. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. If it's negative, it's probably an asset impairment. If it's positive, it's probably a gain on the sale of an asset. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which is negative every year. Here's a breakdown of their quarterly revenue by product. They generated $849 million of revenue from selling semiconductor chips that went into smartphones, $285 million from communications infrastructure and data centers, $218 million from Internet of Things, $100 million from automotive, $113 million from personal computing, and $132 million in NWR. Let me know in the comments if you know what this is. I couldn't find it anywhere. Here's a breakdown of their 2018, 19, and 20 revenue. A bulk of it is in the US. And they have a similar amount of revenue in China, Taiwan, and Europe, Middle East, and Africa. But they sell all over the world. That's what's good about a company like this. They can sell their products all over the world and easily scale. Since they recently IPO'd, they have not published a 10Q yet, so don't have full financials. But this is from one of their most recent presentations. And this is the third quarter of 2020 and the third quarter of 2021. Their revenue was $1.7 billion, up from $1.1 billion. Cost of revenue was $1.4 billion, so they did have positive gross profit in the third quarter, $300 million. Their margins aren't that good, only 18%. The median in the industry is 48%, and the average is 44%. They spent $114 million in R&D, $134 million in SG&A, so they did have an operating profit of $52 million. It was negative $350 million last year. And they had a small positive net income in the third quarter of 2021 of $5 million. Last year was negative $300 million. They spun off from AMD in November, but all these financials, they were underneath the umbrella of Advanced Micro Devices. Now they're their own entity. Since 2018, they earned $32 billion of contracts. They have 5 manufacturing sites in 3 continents, more than 200 customers. But AMD is their biggest customer by far. They shipped 2 million wafers in 2020, and they have an impressive 10,000 patents. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Even though they have an accounting loss, they're generating positive cash flow because operating cash flow is net income converted to cash. So they're generating over $1 billion of cash flow. Operating cash flow is all the cash that's remaining after paying all your day-to-day expenses. And they spend a lot on CapEx because they're a manufacturing company. They spent over $1 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And it was positive in 2020, negative in the other years. They're funding their business on debt, but they haven't added much debt the past few years. It looks like they're paying down more debt than they're adding each year. Except in 2018, they added $2.9 billion of debt, paid down $2.1 billion. But in the other years, they're paying down more debt than they're adding. This is their statement of cash flows, the third quarter of 2020 and the third quarter of 2021. And the statement of cash flows is broken out into 3 sections: operating, investing, and financing. In the operating cash flow, you start with your net income, that was $5 million. We add back depreciation and amortization, that was over $400 million. Because they have lots of fixed assets, factories, equipment, and machinery. That's carried on the balance sheet and depreciated over its useful life. And they had a $640 million cash inflow from changes in working capital. These are changes in accounts payable, accounts receivables, inventory. Even though they only had an accounting profit of $5 million, they actually generated $1.1 billion of cash flow. Last year they had an accounting loss of $300 million, but generated almost $300 million of cash flow. In their investing section, they spent $392 million in PP&E. Last year was $123 million. In their financing section, they repaid a loan for $442 million, and they paid down debt of $87 million. So they had a cash outflow of $525 million. Last year was a cash outflow of $287 million. This is the equity section on their 9/30 balance sheet. They have $6.5 billion of equity. They raised $12 billion from selling their business, and they lost $15.5 billion from running their business. They also received a loan for $10 billion. And this loan is from their biggest shareholder. The good thing about this loan is it was not dilutive. When the company received this loan, they were not a public entity anyway. They were still under the parent company of AMD. Let's look at the capital structure. $6.5 billion of equity, $2.5 billion of debt. They're 72% equity, 28% debt. Their net debt is $1.5 billion. That's debt minus cash. I gave them the middle whack on Finbox, 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2024. That's $28 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $24 billion. We divide that by 532 million shares. And we get a calculated stock price of $45. They're trading at $49, so they're trading at a 10% premium. It's a sell according to the model. Their revenue is projected to increase 11.6%, so I grew their revenue 11.6% for the next few years. That's how I got their future revenue estimates. The average company in their industry converts 20% of their revenue into free cash flow. So I multiplied their future revenue estimates by 20%. That's how I got their future free cash flows. When Intel was looking to acquire this company, they were willing to pay $30 billion. If you based your valuation off of Intel's price, the stock is undervalued. The website Simply Wall Street's valuation is $55. That's saying it's 17% undervalued. 13 analysts priced this stock and the average price target is 78, the lowest 41, the highest 100. So that's a pretty big spread between the analysts. The company IPO'd a few months ago in November, but ever since that point it's pretty much been on a downtrend. So it looks like it could be a really good value at this point. The stock is flat since it IPO'd, the lowest 44, the highest 73, and is trading well below its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock. Of the 532 million shares outstanding, only 55 million are on float. So only about 11% of the shares can be purchased by the general public. 94% of the shares are held by institutions and 5% of the shares on float are shorted. They employ 15,000 people. If you invested $10,000 when this company IPO'd, you'd be down about 5%. 89% of the shares are owned by sovereign wealth funds, 7% by the general public, and 4% by institutions. Mubadala Investment is the biggest shareholder at 89%. They're located in the United Arab Emirates. They own 475 million shares valued at $22 billion. The next biggest shareholder is Fidelity at 2%, then Columbia Management, BlackRock, and Vanguard. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is decent at 5.1. That's stock price over sales per share. And the way you calculate sales per share, it's revenue over shares outstanding. So generally the lower the better. This indicates that investors are paying $5.10 for $1 revenue. You should look at ratios over several years and also compare them to similar companies. Their price to book is pretty good at 4.0, that's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is the value of the company according to the balance sheet. It's assets minus liabilities. Let's look at their non-current assets. $400 million of deferred tax assets. This will help the company reduce the amount of taxes they pay in the future. $8.5 billion of PP&E and $600 million of other. They have a good current ratio of 1.3, so they are able to cover their current liabilities with their current assets. Their quick ratio is a little below 1 at 0.9. Quick ratio is current assets minus inventory over current liabilities. Let's look at their current assets. $1 billion of cash, $1 billion of receivables. This is how much money other companies owe GF, and $1 billion of inventory. Let's look at their current liabilities. $400 million of debt and $2 billion of other. They're not generating much free cash flow, but they're not losing much either. It was only negative $2 million. And they have over $700 million of working capital. Working capital is current assets minus current liabilities. So it looks like they have enough money to get through the next 12 months without needing any debt. The best way to look at ratios is to compare them to companies in the same industry. There are 68 companies in the same industry as GFS, and these are the top 15 in terms of market cap. And GFS spends a little less than average in CapEx. CapEx is investments in property, plant, and equipment. They have a better debt to equity ratio than average. They don't pay a dividend, but they may in the future. They don't really generate any free cash flow. The average is $1.3 billion. They rank 15th in market cap at $26 billion. Average is $40 billion. They do have a good price to book ratio, but we can't look at their PE or price to free cash flow since they have negative earnings and negative free cash flow. But their price to sales is better than average at 5.1. The average is 8.1. They are smaller than the average company, so they're generating less revenue than the average. And they have a negative ROA and ROE since they have negative net income. So to summarize, I have them trading at a 10% premium. Just because I say a company is trading at a premium doesn't mean I wouldn't buy it. Because this is a really popular industry right now. The demand for semiconductors is extremely high. And now that they broke off from AMD, maybe they'll be able to grow more since they'll be more focused on what they're doing. That's generally the benefit of a spinoff. Both entities after the spinoff can really focus on their core business. Where before the spinoff, the parent company had to try to focus on everything and spread money all over. Even though you can go to Walmart and buy almost anything, sometimes you'd rather go to a specialty store, like a particular clothing store, or maybe you want to go to a specialty food store because you like higher quality. Now GlobalFoundries is its own company. It could spend all its resources and time on the manufacturing part and not worry about AMD, the parent. Plus, they have a great relationship with AMD. And that's how this company makes money, is getting contracts from companies like AMD, Nvidia, or even Intel. Even though Intel also does its manufacturing, they do outsource as well. So I think it's a great long-term hold. It seems like most of the big semiconductor companies are good values because there's so much demand for their products, especially in the EV space. And if this company can grow that part of their business, then their stock will go up dramatically. I rank their free cash flows 2 out of 10, their revenue 6 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.